Hey guys, welcome to the podcast. Thanks for joining me. Appreciate it. Well, today is April 23rd, and the stock market is now closed, and we'll get to the general stock market in just a minute. Did want to update you on Apple. Apple did report after the bell. A lot of you always ask about Apple. It's a very popular, probably the most popular tweeted about stock out there, and it's been in this downtrend that we can see going back, since really last September when the stock peaked out around $700, and it broke 400 the other day. So a huge fall, and as it's fallen, of course, the debate has been, is this turning into a slow value stock, or is this a stock that has something left in the tank? Or is it a company like seen it compared to Zenith, which I think is kind of ridiculous, or is it just simply a Nokia where the technology world passes it by? And it's amazing when you go back just a year ago how this was the most over-owned stock and nothing could go wrong, and people were loading up on it. And as is typically my mantra, I generally fall in between of not doing anything one way or the other too heavily. So I own Apple, but it was never a huge part of the portfolio. Conversely, I didn't not own it. And, there's people that didn't own it, and there's people that own too much of it. And fortunately, I've been in between. And I think if you look at Apple right now, if you look at their fundamentals going backwards, you would say, how does the stock ever get this low? But here's the deal. Apple comes out. They did beat earnings estimates, which were $9.98. They came out at $10.09. They beat revenue estimates. However, going forward, their revenue is going to be somewhere between $33 and $35 billion in the third quarter, but the street's expecting $38 billion. Now, the stock has opened up in the after hours, and it's up about 5%, about 426, which if we look at it here, it would be trading somewhere around here. So it still hasn't, even though it's up in the after hours, it hasn't broken the downtrend, and I don't necessarily think that this is the bottom. I wouldn't, if I'm sitting there, do I rush in and buy some? Not necessarily, and I think here's the reason why. The stock is trading up because they basically upped their dividend by 15%, not a huge amount. It's not as if they doubled their dividend. They upped it. They did increase their share repurchase. They've upped it by $50 billion. So it was at $10 billion, and now they've upped it to $60 billion. So basically, they're going to use in dividends and in share repurchases, they're basically going to return $100 billion back to the shareholders. So a really large, and we're talking some huge numbers here. But here's the deal. I think at a minimum, you look at this and say, okay, their dividend yield's probably over 3% now. They're buying back a lot of stock. And when you're talking $50 billion, remember, this is a $366 billion company. So a $50 or $60 billion share repurchase, they're going to buy back about 20% of the outstanding shares out there. So it may put a floor in, but does the stock take off? I don't necessarily think so. I think, they're still guiding down. So we're still in this kind of chasing the carrot where the stock is following the fundamentals deteriorating a bit. But let's just say it is turning into a slow growth value company, a large cap value. This is still a stock that pound for pound, when you look at a portfolio, belongs in a portfolio. You got a stock that yields over 3. They have no debt. They have $150 billion in cash. They're going to return $100 billion to you, even if they're growing at a mediocre 10% a year. Take out their cash, they're basically trading at a PE of somewhere between 6 and 9. So if you've got a few years to go, this is a stock that I think should be a core holding in a portfolio. And it should have been at 700. But there's no question that the fundamentals have deteriorated, and so for you to say, well, they were cheap at 700, so they must be really cheap now. Don't forget the fundamentals have deteriorated as well. Their margins are dropping. Their revenue is coming on lower than expected as far as the estimates going forward. So now hopefully things will be better than what they're saying, but they may be saying, hey, we're gonna guide way down so we can beat on the upside next quarter. But as I've said before, it's all about, to really turn it around, it's about the next product. That's really all the street cares about right now. Can the stock stabilize at 400 to 450? Sure. But is it going to go back to 700? Only if they go and really innovate again. And they've spent a lot. I don't have a graphic up on it, but they are spending a bunch of money on CapEx and on research and development. They are going out there, and that's something that's building the pipeline. So we know they have the best people trying to build the next wow product. Can they do it? And I'm not going to answer for them. They have to prove it to me, you, and all the other investors on Wall Street, and they haven't done it yet. So let's see if they do it. But the stock is compelling, obviously. If you've never bought it, it's compelling right now. Looking back at it over a weekly picture, after this massive run, of course, that it had had the last several years, I really think this range that it had been in, let's call it 350 to 420. That's a range that seems to be something that it could get stuck in for a while before it really turns the corner. But it may be starting the process of in the broadening process, and the reason why is because they have finally said, yes, we're going to return a lot of money back to shareholders, and it's not just in the form of a dividend. I frankly am happy that they didn't boost the dividend way up. I would rather them see them buy their own stock back, because it tells me that they think it's cheap. Innovate, buy a lot of stock back, and the stock will go up. So Apple right now is up, as I mentioned, after hours at about $426, up 28 bucks. So a good 5-6%, but still not breaking this uptrend. This downtrend. Once it does that and stays above it, maybe comes back and tests some old lows and then takes off again, maybe you've got something. But I don't think this is going to V-bottom. I could be wrong, but I don't think this is going to V-bottom. I don't think there was enough there to wow people to say, I've got to get the stock. It's going back to 500 in the next couple of days. I think that it still will gyrate down here for a while, but it was a kind of a mixed report. Obviously, it was good that they beat estimates on both the revenue and earnings, but not as good going forward that they didn't say, hey, the worst is behind us. So we'll have to see, but obviously the news continues to come out on Apple, and that's all people were kind of wanting to see after the bell, it seemed like. Now, overall on the broad market, let me show you a little picture here, and I'll show you the Dow Jones. And in case you don't follow the market intraday, which is fine, some of you may not, see this little down bar. These are 5-minute pictures, and actually what I'll do is I'm going to change this to a 1 minute so we can actually see what's going on here. No, there's not a glitch in my program. We're moving along here, and the market all of a sudden just completely falls. It was up about 130, 140 most of the day, and fell to even within about 2 minutes. And about 2 minutes later, it goes back up. People are texting me what's going on. I'm saying I'm not sure. Don't see anything just yet. And within a couple of, really just as quickly as it happened, it ended. And apparently what happened, and I found this, Bloomberg, Twitter, whatever, AP, the news wire agency, had reportedly put something on their Twitter feed saying that the White House, there was an explosion at the White House, and President Obama had been injured. And some of the staff from AP tweeted out right after that it was that they'd been hacked. And but it just shows you, when you look at these drops, which are very reminiscent of the flash crash, very reminiscent. When you look at this, to me, the thing that now again, if you're just come home from work and you're saying, big deal, the market was still up 150, it went like this, it came back, and it's like nothing ever really happened, and we went higher. But here's the thing: it tells me that the system is still broken, and that we hear the high frequency traders say that they are there to provide liquidity to the market. If it wasn't for them, we wouldn't have this fluid, liquid market. Well, apparently they went out to lunch during that time or decided to turn off their machines because they weren't providing liquidity. When you see a drop of 100 points, 130 points in seconds, that's a lack of liquidity. That is people selling and the liquidity not being there to soak it up. So that's kind of bogus, and it tells you that any piece of news can drive this market down, and it's very scary. And so what's the moral of the story? The moral of the story is that you don't have all your eggs in one basket. And what does that mean? That means don't own every piece of investment you own is in the stock market. Because what if it hadn't come back? What if it had fallen 1,000 points? What if this was true? You see how fast the market can fall. And so that's why you still have to have a balanced approach of owning some treasuries, owning some. And when I say that, I obviously a lot of you may be believing that treasuries are in a bubble, and I do too. But on a day where the market falls, treasuries act as a nice hedge. So some form or fashion, owning some acts as a hedge, even if it's by itself isn't a good investment. Owning some income-producing things, owning some REITs, owning some specific companies that do different things, you have to diversify that way because of what we saw today, which was this mini flash crash. And, you know, the flash crash was, we'll be coming up on the flash crash anniversary in about 3 weeks. And it was 3 years ago that we had that flash crash, and I've never heard an explanation of why it happened or how we fixed it. And I think today is a perfect example of that it can happen again. And so we must be aware of that. And, you know, you have to prepare for something like that to happen again. Before 9/11, we didn't really take into consideration real terrorism into our risk models. That wasn't in there. Now we do. Before the flash crash in 2010, we didn't take in consideration that into our risk models. Now we do. And so this is something that probably won't go away, and we just have to deal with it. But it's scary, and it does show you that, you know, I don't know, and you might be thinking, how could it fall that fast? Well, it's because maybe there aren't humans doing this. You know, you have things that are programmed, and maybe it's algorithms set up to see things like explosion or the White House or Obama injured. You don't know how these computers are programmed to sell. And you may be laughing saying they're not programmed like that. Yeah, they are. And there's no way that a human could see something like that, go figure out how many shares to sell, hit the sell, but that doesn't happen that way. This is all computer related and algorithms and high frequency trading. And that's the negative side of it. Does it provide liquidity? Sure, on some days, but when they tend to provide liquidity when things are going up, right? They'll sell to you and you can buy at higher prices. They don't seem to want to buy from you when you're trying to get out and the market's falling. And that's why we see these big gyrations. So that's what happened today. I mean, overall, going to the overall market, taking that out of the equation, the stock market continues to move higher. And, you know, this has been the last couple of weeks have been a time, and I mentioned this on the prior podcast, that we've had these 3, 4, 5 day sell-offs that really felt like perhaps the whole thing was rolling over. And it really felt like that here, especially since we broke this uptrend. But this turned out to be a big head fake. So the question you have to ask yourself is, did you sell on this and get extremely defensive only to be sitting out right now watching the market go up? And I know some of you have, because I've read your tweets. I see your emails. Some of you had the big head fake, like maybe back here. And if you are, you have to figure out, where did that part go wrong? Not to say that it's going to go up forever. I'm just pointing out that where your system's calibrated too tightly, to where it went down for a couple of days and whatever system you're using says sell. Or maybe it's just your mind. Maybe it's your emotions, which aren't very good to trade off of. But whatever it is, go back and research it and see what happened and why that happened. And maybe you need to change your systems or tweak them a bit, or whatever the case may be. I've been doing very little trading in the last few days here because of the whipsaw nature. And primarily it's because a lot of my systems didn't trigger. But number two, I think if you look at what's happening right now, I don't see an overwhelming supply coming onto the market. So in other words, I think we've been seeing some sloppy trading in here, where stocks have been looking, or investors, or whatever you want to say, have been looking a little tired. We haven't seen the oomph that we would typically see, and we haven't seen that real demand. And so you've been seeing people very willing to take profits, some things breaking down. You've seen some kind of risk-off days, but it didn't seem to me either party was winning, and that's why I didn't make a lot of trades, because I didn't see that either side was winning on the long side or the short side. I didn't see which side was winning. It looked like a tug-of-war, and for a couple of days, it looked like maybe the bears were going to start to pull the rope a little tighter, and the bulls have reclaimed that today based on better earnings in the last day or two. And, volume was a little higher today. I think it was 20% higher than yesterday's volume. And we did see things like the Russell 2000 lead, which they had been falling or lagging. But you saw them up about 1.6% today. So they kind of bounced right off the 100-day moving average, and they're now sitting underneath the 50-day moving average. So those that are technical out there, what are you worried about? What you're worried about is that you want these things to be leading, and instead what you're seeing is this kind of rolling over, and is this going to happen? And meanwhile, the actual market is going below it and has trouble going back above it, and we fall. And again, the jury's out how that's going to play out, but I do think that if you're doing a lot more trading here, you're probably getting whipsawed, especially, think about it, if you had stops in today. They got triggered within about 2 minutes of that fake AP tweet. And obviously, you get stopped out, it gets triggered, and the market goes right back up and goes up without you. So be careful about how you're doing things. But overall, the market did regain some of that strength back today. It wasn't overwhelmingly strong, but it was definitely a reasonably good day. And of course, don't forget that the Apple is still a big part of the overall NASDAQ. So if Apple does move forward and stay up and keeps this gain overnight, it'll have a big help to the NASDAQ tomorrow, which will increase the overall tone of the market. Now, just running through a few things. Of course, we have, oil has been it broke that uptrend that we had been looking at for a few days. And remember, I had said at the time, the longer this pattern went, this kind of wedge pattern, the longer you go to the end, it typically breaks to the downside, and that's exactly what happened. Usually when we want to break to the upside, it happens earlier in the pattern, and that didn't happen. And so it kind of played out the way we thought it would, which was got to the end and oil broke down. Doesn't mean that the deal's over. It's just this little uptrend we were in broke. When we look at interest rates, treasuries have really been not doing a whole bunch in the last few days here, and overall, I think you're not seeing, even though the market's been rallying the last few days, you're not seeing interest rates really spike up. In other words, money hasn't been coming out of bonds to fund the stock market going up in the last couple of days, which tells me that's fresh money coming into the market. So that's a little bit of a healthy thing. And of course, we're still seeing some of the things like utilities, healthcare, they aren't leading anymore. They're just kind of going up with the market, maybe even lagging a bit. So you could start to see a rotation going on in some of the underperforming things. Remember, what's been underperforming? Things like emerging markets have been underperforming. They were only up 0.5% today. Do we start to see a rotation out of things like consumer staples, healthcare, utilities, and into technology, emerging markets? Those are the things that have been lagging. And really, pound for pound, when you look at what's a value right now, emerging markets are probably a pretty good value because their growth compared to what you're paying for that growth is pretty cheap. And same thing with overall technology. And I think technology, most of their sales do come overseas, and that's why you've been seeing them lag behind as people have been worried about, obviously, a slowing China, obviously a struggling Europe. And so you've been seeing technology not lead the way, and perhaps it starts to lead the way, and it'll certainly get a boost tomorrow with the move in Apple, again, assuming that it continues on that pace. All right, folks, I did want to cover a lot more, but we had the Apple earnings, which some of you may not care about because maybe you don't own Apple, you don't want Apple, you don't like Apple. So sorry, a lot of people do, and a lot of people talk about it, so I figured I'd go ahead and lead with that. But the overall market, I wanted to touch on that because really in the last few days, we've seen this really zigzag back and forth. And again, it's been a lot of noise, but we haven't really seen any definite patterns breaking out one way or the other. So time is kind of up. And don't forget to check out twitter.com/Carl Eggers. Also, we are on eggerscapital.com. We're on Google+. We're on Facebook. We are on iTunes. And you can just come on over to carleggers.com if you want as well and sign up for a free email subscription. All right, guys, thanks for watching, and we will talk to you soon.